Welcome to the deep dive. Today we're embarking on kind of a fascinating journey into what might seem like two completely unrelated documents.
Yeah, they do seem different on the surface.
On one side, we have this list of, well, powerful questions, the kind designed to spark genuinely insightful conversations.
Right.
And on the other side, a rather candid letter to shareholders. This one's from 2001, penned by the legendary investor Charles T. Munger himself, concerning WESCO Financial Corporation.
And our goal for you today is really to pull out the truly essential nuggets of wisdom from Munger's letter. It reveals, the real-world complexities of business and finance during a very specific, challenging time.
Okay.
Then we'll try to weave these insights back to that list of questions. We want to show you how a deep analysis of just one detailed document can implicitly provide, profound answers to many of those insightful queries.
So it's about getting informed quickly, thoroughly, and maybe seeing those aha moments where complex ideas just kind of click into place.
Exactly. Connecting the dots.
Okay, so let's jump right into the heart of it. We're primarily focusing on Charles T. Munger's letter, the one from March 5, 2002, which lays out WESCO Financial Corporation's performance for the calendar year 2001.
Right, that specific year.
Now, looking at the top line numbers, the consolidated net operating income, and that's before any one-time gains, it took a pretty significant hit in 2001.
It really did.
Fell to just over $52.5 million, or 7.38 per share. That's down from a much healthier $70 million, or 9.84 per share back in 2000. That's a clear signal something impactful happened.
Oh, absolutely. And if you look at the consolidated net income, the picture becomes even more dramatic, doesn't it?
Yeah.
It mirrored the operating income, $52.5 million in 2001, but that compares to, get this, a staggering $922.5 million, or nearly $130 per share in 2000.
Wow, $130 per share versus $7.38.
Exactly. That monumental difference, the kind that would make any investor's head spin, was almost entirely due to something Munger makes very clear. The complete absence of massive securities gains in 2001. Those gains had hugely inflated the 2000 figures.
So that immediately tells you not all earnings are created equal. You have to look under the hood.
Precisely.
It really highlights how a single large event, or lack thereof in this case, can completely skew the reported numbers. So to understand how WESCO weathered this storm, we need to look at its four major subsidiaries, right?
Yep, the core businesses that contributed to these figures.
WESCO Financial Insurance Company, or West Food, the Kansas Bankers Surety Company, KBS, Court Business Services Corporation, which is in furniture rentals, and Precision Steel Warehouse, Inc.
Let's peel back the layers and see what Munger tells us about each one. Should we start with insurance?
Yeah, let's start with the insurance side, WESFIC and KBS.
Okay. WESCO Financial Insurance Company, WESAC, actually faced its worst underwriting results since it first got into the insurance business back in 1985.
Worst ever up to that point.
Yeah. And what's truly striking here, and a very stark real-world example of external shocks, is the primary cause Munger cites for that substantial underwriting loss in 2001.
Let me guess.
He termed it a man-made catastrophe on September 11. He notes it was the insurance industry's largest loss in history. WESCO recorded an estimated loss of $10 million before taxes, or $6.5 million after taxes, specifically tied to 9/11.
Right, and he notes the potential for estimation error there, too.
Of course. But it immediately tells you about the unpredictable nature of global events on even seemingly stable industries like insurance.
Despite that colossal hit, WESIC still managed to benefit from a few things. One was the proceeds from investing its float, and for those maybe unfamiliar, float is essentially the premiums an insurer collects and holds on to before it has to pay out claims.
It's like an interest-free loan they can invest, classic Buffett and Munger strategy.
Exactly. And they also saw favorable loss development, which actually boosted after-tax operating earnings by $0.8 million in both 2001 and 2000. This was thanks to a terminated 1989 reinsurance arrangement with Fireman's Fund Group.
So, past deal still having an impact years later.
It speaks to the long tail of insurance, definitely.
And that float is, like you said, a classic Berkshire Hathaway advantage Munger brought to WESCO. WESCO also engaged in other reinsurance business, including supercat reinsurance.
And really big catastrophes.
Yeah, policies covering exceptionally large catastrophic events, often alongside other Berkshire Hathaway subsidiaries. And here's a unique beneficial arrangement. WESCO received a 3% of premiums ceding commission.
So they got paid for passing on the risk.
Right, a fee paid back to them for passing on part of the risk, and they had virtually no insurance acquisition or administration costs on those specific policies. It's Munger finding efficiencies, leveraging those partnerships within the Berkshire family.
Very smart. Okay, shifting to the Kansas Bankers Surety Company, KBS. Wescofake acquired them in 1996 for about $80 million cash.
And KBS stands out because it was a solid, growing contributor to WESCO's earnings. It brought in $9.3 million to after-tax operating earnings in 2001, which was actually up from $7.0 million in 2000.
So in a challenging year for WESCO overall, this division was actually a bright spot, a consistent performer.
Definitely. And KBS has a fascinating history, chartered way back in 1909. Originally, its whole purpose was to underwrite deposit insurance for Kansas banks.
Wow, 1909.
Long time. Today, it mostly serves small and medium-sized community banks across, I think, 27 mainly Midwestern states. And they've strategically expanded their offerings beyond just deposit bonds. Now they do things like directors and officers, indemnity policies, bank employment practices policies, that sort of thing.
So a story of a niche business with deep roots, diversifying smartly over time.
Exactly. And it demonstrates Munger's preference for simple, understandable businesses, doesn't it?
It does. Interestingly, KBS changed its retained volume effective 1998. Before that, they used to cede or pass on almost half of their premium volume to other insurers.
But now they reinsure only about 5%. And of that small portion they reinsure, other Berkshire subsidiaries take 50%.
So they're keeping more of the risk themselves now.
Right. And this increased retention, as you might expect, leads to increased irregularity in their income stream. Their profits can swing more from year to year.
It's a trade-off.
Yeah.
More risk, potentially more reward.
Yep. But despite that, their combined ratio, that key measure of an insurer's profitability where lower is better, has been, in Munger's words, much better than average for insurers. It was 55.1% for 2001 and 73.9% for 2000.
Those are excellent figures.
Yeah.
Really shows strong underwriting discipline.
Absolutely.
Huh.
And Munger also makes a point of commending Donald Tell for his capable leadership there, again emphasizing the importance of good management.
Always comes back to people, doesn't it?
It does.
Okay, let's turn to Court Business Services, WESCO's venture into the furniture front. WESCO acquired Court in February 2000 for $386 million in cash.
A pretty substantial acquisition.
Yeah.
Court is the country's leader in rent-to-rent furniture rentals, which is distinct, as Munger points out, because the lessees have no intention of actually buying the furniture.
Right, it's not lease to own, it's pure rental.
Exactly.
Yeah.
So Munger draws an analogy. Like Hertz selling used cars, Court has to be really skilled in managing and eventually selling off its used furniture inventory to make a profit.
That makes sense. It's a key part of the business model.
And Court's contribution to WESCO's consolidated operating income took a severe dive in 2001.
How bad was it?
It was $13.1 million for the entire year 2001, compared to $29.0 million for just the 10 months WESCO owned it in 2000.
Ouch.
If you annualize the 2000 figure, it translates to a shocking 61% decline year over year. And Munger spells out the reasons clearly. The burst of the dot-com bubble, continued weakness in the U.S. economy, and, of course, the profound impact of September 11.
So a trifecta of negative factors hitting them hard. It's a vivid illustration of how macroeconomic events can directly hammer a seemingly unrelated business like furniture rental.
Definitely. They also launched a new subsidiary, Relocation Central Corporation. Munger highlights its rough start. $12 million in expenses versus only $1 million in revenues in 2001.
Not exactly profitable out of the gate.
Not at all. But their strategic goal was to become the principal source of rental furniture to the apartment industry through an internet-based leads operation. It's a classic Munger move, isn't it? Investing for the long term, even when it looks painful in the short term.
Yeah, planting seeds.
And that's actually where the good news for Court lies amidst all the challenges. Despite the decline in reported income, Court actually operated at a positive cash flow.
Okay, cash flow positive is key.
Very key for Munger. In 2001, it reduced its line of credit debt by $32 million and invested an additional $20 million in business expansion through acquisitions.
Ah, so using the downturn.
Exactly. Munger's view on this is very instructive. He says he'd happily tolerate a poor part of the business cycle when we turn it to our advantage by expanding business through cash acquisition at sound prices.
That is core Munger philosophy right there. Using downturns to acquire assets when others are forced sellers or just scared.
Turning adversity into advantage.
It's also worth noting, you mentioned the purchase price, About 60% of Quartz purchase price was attributed to goodwill. That's the premium paid over the fair value of identifiable net assets.
Right, reflecting things like brand reputation, customer relationships, those intangibles.
And Munger, again, gives a shout out to the leadership, Paul Arnold, Quartz longtime CEO, calling him a star executive.
People matter. Finally, for the operating businesses, we have Precision Steel Warehouse, Inc.
Steel business.
Yeah, its contribution to net operating earnings was also significantly reduced, down to just $0.4 million in 2001 from $1.3 million in 2000.
Another tough year.
Very. The reasons were pretty straightforward. A significant reduction in demand for steel and intensified competition. This led to a nearly 30% decrease in pounds of product sold and about a 25% decline in sales revenues.
It's a tough, cyclical business facing headwinds.
Precisely. A reminder that even fundamental industries aren't immune to economic cycles.
Munger also mentions LIFO inventory accounting adjustments. That's a specific way of valuing inventory, last in, first out.
Right, and it can impact reported profits, especially with changing commodity prices. But Munger stresses that these adjustments, while they affect the income statement, don't necessarily predict future earning power from his perspective.
It's a technical accounting detail that doesn't always reflect the underlying business strength or weakness.
Exactly. And just like with Court and KBS, Terry Piper is praised for his leadership through what Munger describes as difficult years, again, underscoring the value Munger places on strong management during tough times.
Okay, so that covers the main operating businesses. Now let's shift focus maybe to some key financial concepts and Munger's broader insights. He always has some gems in these letters.
Absolutely. This is where you really get his unique way of thinking. First, let's talk about the nuance of goodwill.
Right, we mentioned Court had a lot of it.
Yeah. WESCO's reported earnings were reduced by about $7 million of goodwill amortization in 2001. That was the old accounting practice of systematically writing off a portion of that premium paid for an acquired company each year, whether its value declined or not.
A predictable charge against earnings.
Correct. But here's what Munger highlights. The Financial Accounting Standards Board, FASB, issued a new pronouncement that eliminated this automatic goodwill amortization starting in 2002. Instead, it was replaced with an annual impairment assessment.
So instead of a fixed write-off every year, companies now just have to check if the value of their goodwill has actually dropped below what they carry it for on the books.
Exactly. And Munger states this change will make future reported earnings more closely reflect microeconomic reality. In other words, the reported numbers will better show the actual health and value of the business rather than being dragged down by an arbitrary accounting charge from years ago.
That makes sense. WESCO's consolidated balance sheet contained about $264 million in goodwill at that point, with $27 million specifically from the KPS purchase. This is a perfect example of how accounting rules can dramatically change reported earnings without the underlying business changing one bit.
A really important distinction for investors to grasp. And this leads us to another massive yet often misunderstood financial concept: the impact of those securities gains, or lack thereof.
Ah, yes, the $922 million versus $52 million net income difference.
Exactly. Remember that enormous difference between 2000 and 2001? WESCO realized a staggering $852.4 million in after-tax securities gains in 2000, principally from selling Freddie Mac common stock.
And then basically none in 2001.
Right. No such gains in 2001, which is why that net income number plummeted. Munger's message here is crystal clear. Don't get fixated on one-off gains as a measure of a company's ongoing, sustainable profitability.
It's absolutely crucial to understand the source of earnings. Was this profit from the actual business operations or selling off an asset?
Precisely. And the story behind this Freddie Mac stock is fascinating, too. It was initially purchased by Mutual Savings, which was WESCO's former S&L subsidiary, for a mere $72 million.
$72 million.
And it was carried on WESCO's balance sheet at an impressive $1.4 billion at year-end 1999.
Incredible return.
Absolutely huge. So while realizing that gain had a massive impact on reported earnings in 2000, Munger points out it had a very minor impact on shareholders' equity.
Oh, so?
Because the amount was simply switched from the unrealized gains account, which was already part of shareholders' equity, to the retained earnings account, also part of equity. It was already conceptually part of the company's wealth, just reclassified on the balance sheet when the stock was sold.
Ah, okay. So the wealth didn't suddenly appear. year. It was just recognized differently for accounting purposes.
Exactly. And building on that, Munger introduces this really interesting concept of an interest-free loan from the government.
Okay, how does that work?
He explains it as the deferred income taxes on unrealized gains. Essentially, when you have a big unrealized gain like WESCO did with Freddie Mac, you owe taxes on it eventually, but not until you sell. So until you sell, you get to hold on to that tax money and use it. It's like an interest-free loan from Uncle Sam.
So you get the benefit of investing the government's money, basically until the tax bill comes due.
That's the idea. The sale of the Freddie Mac shares in 2000 was primarily responsible for reducing this loan from $705 million at year-end in 1999 down to $199 million at year-end 2001 because they paid the taxes.
So they repaid a big chunk of that loan by selling the stock. At year-end 2001, this remaining loan amounted to about $28 per WESCO share.
But, and this is crucial Munger pragmatism, he makes it clear, it's not a perpetual advantage for shareholders. As additional securities are sold, more of this loan will be removed.
Right. Don't count on it forever. It highlights Munger's focus. Even a great benefit like this isn't eternal. A wise investor focuses on sustainable advantages, not just temporary accounting or tax boosts.
Well said. This deep dive into WESCO's financials naturally raises an important question, especially for anyone familiar with Munger. How does WESCO compare to his flagship, Berkshire Hathaway?
Yeah, it's just a mini Berkshire.
Munger addresses this head-on. He states, very bluntly, that WESCO's business and human quality continues to be not nearly as good as Berkshire Hathaway.
Wow, no punches pulled there. Direct comparison.
Zero punches pulled. He explicitly states WESCO is not an equally good but smaller version of Berkshire Hathaway. Better because its small size makes growth easier. That's a common argument for smaller companies, but he refutes it here.
So what's his assessment then?
Instead, he says, each dollar of book value at WESCO continues plainly to provide much less intrinsic value than a similar dollar of book value at Berkshire Hathaway. And critically, he notes this disparity has been widening.
That's a powerful, incredibly candid assessment from the chairman himself, highlighting fundamental differences in quality between the two companies he runs.
It really is. However, Munger importantly makes no attempt to appraise relative attractiveness for investment of WESCO versus Berkshire Hathaway's stock at present stock market quotations. He's focused purely on the underlying business quality, not the stock price.
A key distinction. So, looking ahead for that point in 2002, what was his view on WESCO's strategy?
He meets that WESCO plainly needs more favorable investment opportunities, preferably in acquiring whole companies like Court, or, as an alternative, in marketable securities for its insurance subsidiaries.
So capital allocation is key. Always looking for the best place to put cash to work.
That's his main job, really. And here's a really significant takeaway, especially if you're interested in his market outlook back in early 2002, after the dot-com bust but before the next big run-up.
What did he say?
Munger reveals, and I quote, "The thing that should interest WESCO shareholders most with respect to 2001 is that we found no new common stocks for our insurance companies to buy. We are not excited by general prospects for common stocks."
Wow. So Munger, ever the contrarian, basically saying in early 2002, nope, market's not attractive, nothing cheap enough for us to buy. You can almost hear the collective sigh from Wall Street, but the calm confidence from Pasadena.
That statement just encapsulates his deep value discipline. If there's nothing compelling to buy according to your standards, you wait. You don't force it. You don't lower your standards.
Patience is paramount.
Absolutely. Yet, despite all the challenges of 2001 and his less than thrilling outlook for general stocks, the board of directors did recently increase WESCO's regular dividend slightly, from 31.5 cents per share to 32.5 cents per share.
A tiny increase, but maybe a small signal of confidence in the underlying non-speculative operating businesses.
Perhaps, or just maintaining a long-standing policy.
Okay, this is fascinating. Now let's try to connect these two seemingly disparate sources we started with. On one hand, we have this list of insightful questions, the kind designed to spark thought-provoking conversations about business and life.
Right.
On the other, we have this detailed, maybe even dry-seeming financial letter from Charles Munger about WESCO in 2001. What's really interesting is how Munger's letter implicitly answers so many of the types of questions on that list. It's like a real-world case study in how those abstract questions play out.
That's a great way to put it. Let's unpack this with some direct examples, drawing from that list of questions you mentioned. From the business and entrepreneurship section, one question might be, what's the biggest challenge you faced as an entrepreneur?
Okay.
Well, Munger's letter gives us a direct, tangible answer right there with Court. Its struggle with the burst of the dot-com bubble, the continued weakness in the U.S. economy, and the devastating events of September 11. It wasn't just theory, it was a real-world triple threat hitting their business model hard.
That's a very concrete answer. Another great one from that section could be, how do you stay innovative in a competitive market?
And again, Court provides an example. The launch of Relocation Central Corporation, despite its initial losses, remember, $12 million in expenses versus just $1 million in revenues in 2001.
Right, bleeding cash initially.
But it serves as a clear example of strategic innovation. They were losing money on it in the short term, but they had a clear long-term vision. Become the principal source of rental furniture for the apartment industry using an internet-based leads operation. That's attempting innovation under pressure.
Investing through the pain for a future payoff.
Exactly. And how do you measure success in your business? Munger's discussion of Court is a perfect illustration here, too. Despite that nasty 61% decline in reported operating income, what does he highlight?
Positive cash flow and making acquisitions.
Right. Positive cash flow and strategic acquisitions during a downturn. This shows his focus is on a deeper, more long-term measure of success than just the immediate earnings statement. For Munger, success often means leveraging difficult times for future advantage, building intrinsic value.
Okay, moving to the investing and finance section of questions. If you asked, how do you evaluate a good investment opportunity?
Munger's explicit statement about WESCO needing more favorable investment opportunities, ideally whole companies, and his distinct lack of excitement for common stocks in 2001 speaks directly to his evaluation criteria. It's not just about what he would buy, but critically what he wouldn't buy and why. Discipline.
The discipline of saying no. What's your approach to risk management?
You can clearly see it in action in the letter. Look at KBS's careful reinsurance strategy, deciding to retain more risk now, only reinsuring about 5% of their premium volume. That demonstrates a calculated, controlled risk appetite.
Okay.
And then there's WESF's swift and transparent accounting for the unprecedented 9/11 losses, even acknowledging the estimation errors involved. That illustrates a deep awareness and a very practical approach to managing catastrophic, unpredictable risks.
Facing reality, however harsh.
Precisely.
And finally, from the deep and reflective category of questions, how do you deal with uncertainty?
Well, the direct impact of 9/11 on both WESFEC and Court provides a stark example. And Munger's calm assessment of the estimated losses, combined with his continued focus on long-term strategy despite those extreme, unforeseen impacts, that demonstrates a robust and pragmatic approach. He deals with profound uncertainty by acknowledging it, assessing it rationally, and sticking to his long-term plan where possible.
He's not flustered by what he can't control, but methodically assesses and adapts.
Right. And one more from that reflective pool. What role does failure play in your growth?
Interesting one.
The 61% decline in Court's operating income is, on the surface, a clear failure, right? In terms of immediate financial performance, it looks bad.
Yeah, definitely a setback.
Yet, how does Munger frame it? As an opportunity for expansion through acquisitions at sound prices. He turns that setback into a strategic move for future growth. It's a powerful lesson in reframing challenges as opportunities, learning from adversity.
So you can really see how a deep dive into a detailed report like this, even one that seems, just focused on numbers and business units from decades ago, can reveal profound insights and practical answers to these big, complex questions about business, investing, and even leadership.
Absolutely. It's about looking past the surface to find the underlying wisdom and the real-world lessons contained within, far beyond what headlines usually convey.
So, just to recap, we've explored the fascinating, sometimes harsh realities of corporate finance and strategic leadership through Charles Munger's incredibly candid reflections on WESCO's 2001 performance.
We saw the direct, unavoidable impact of major global events like 9/11 right on a company's bottom line. We saw the strategic long-term plays in insurance, like managing float and reinsurance.
And we saw how a downturn, like the one hitting Court and Precision Steel, can actually be viewed strategically as an opportunity for growth and acquisition if you have the right mindset, and crucially, the cash.
And we discovered how that list of questions, seemingly abstract, actually provides a powerful lens for understanding the nuances hidden within a complex financial document like this letter.
It really does. This deep dive into WESCO's letter, paired with thinking about those insightful questions, truly highlights the power of looking beyond the headlines, beyond the surface noise, and digging into the details.
So it leaves you wondering, doesn't it? What other real-world reports or data sets out there, things that might seem mundane or impenetrable on the surface, might hold equally profound answers to the big questions we have about business, life, and innovation? If only we knew how to look, how to analyze them properly. What stands out to you from today's deep dive?